Have you ever wondered how fast a normal life can turn into a financial nightmare without warning? What if the biggest danger in a collapse is not losing money in the market, but trusting the wrong things to stay safe when the ground starts moving? If you want clear lessons from history that could protect someone you love, tap like, subscribe, and share this video before we go deeper, because one smart reminder today may save years of regret tomorrow. Picture a man in America in late 1929. He's not reckless, he's not greedy, he's not gambling his future away in some smoky back room. He works hard. He pays his bills. He owns a small business. He saves money in a bank. He believes that if he stays disciplined, life will stay stable. Then the economy cracks open. At first, he does not panic. Most people do not. That is one of the most important lessons from the Great Depression. Disaster rarely arrives with a trumpet. It comes in pieces. A bad headline, a nervous banker, a customer who says he will pay next week, a supplier who suddenly wants cash, a friend who loses his job, a stock price that drops, then drops again, then drops so much that people stop looking because the truth hurts too much. And still, life goes on. Stores open, trains run, children go to school, dinner gets made. That is why so many people miss the real danger. They are waiting for life to look like a movie scene. But economic collapse usually begins while everything still looks almost normal. When people talk about the Great Depression, they often focus on the crash of 1929, the panic on Wall Street, the famous photos, the breadlines, the dust, the faces. But the deeper lesson is not just that markets can crash. Markets have always crashed. The deeper lesson is that an economy can slowly stop supporting the people who trusted it. And when that happens, the things that looked safe in good times can become traps in bad times. That is why this subject matters now, not because history repeats in a perfect circle. It does not. The world today has different technology, different laws, different financial tools, and faster information. But human behavior has not changed much. Debt still expands during optimism. People still mistake rising prices for real security. Institutions still look strongest right before stress tests them. And families still build their futures around assumptions that can fail when the pressure gets high enough. So this video is not about romanticizing the past. It is not about fear for the sake of fear. It is about learning what the Great Depression revealed with brutal clarity. What actually protected ordinary people. What destroyed them. What stayed useful when systems weakened. And how should a person think about money when the future stops feeling guaranteed? To understand that, we need to start with a hard truth. The Great Depression was not only a rich man's stock market story, it became an ordinary person's survival story. In the late 1920s, many Americans believed they were living in a new age of permanent progress. Industry was growing, new products were everywhere, credit was expanding, stocks kept rising. Optimism became a kind of public religion. And when optimism becomes a religion, doubt starts to sound like weakness. That is when danger grows. Some people bought stocks with borrowed money because it seemed foolish not to join the boom. Some businesses expanded because demand looked endless. Some families took on obligations because tomorrow seemed more secure than yesterday. On the surface, this looked like confidence. Underneath, it was dependence. The system only worked as long as prices stayed strong. Jobs stayed available and credit stayed easy. Then confidence broke. But here is the point many people still miss. The market crash was the spark, not the whole fire. The full disaster came from what happened after the panic spread through banks, jobs, farms, wages, businesses, and daily life. A falling stock chart may scare investors. A failing banking system can break entire communities. Between 1930 and 1933, thousands of American banks failed. Think about what that meant in real life. Imagine walking into a bank where your savings have been sitting for years. Maybe your emergency fund, your business cash, your family reserve, and learning that the bank is shut. Not tomorrow, not for a few hours. Shut. Maybe your money is frozen. Maybe it is gone. Maybe the institution you trusted is too weak to honor what you thought you owned. That is a different kind of fear. A stock market loss hurts on paper. Losing access to cash hits the body. Rent still comes due. Food still costs money. Your children still need shoes. Your supplier still wants payment. That is when ordinary people discovered a harsh lesson. Money is not just about value. It is about access. In a crisis, access can matter more than almost anything else. And once banks started failing, fear multiplied. People rushed to withdraw deposits. Those withdrawals weakened banks further. Weak banks created more panic. More panic caused more withdrawals. It became a spiral, not because everyone was irrational, but because under stress, even rational people can help destroy the system they are trying to protect themselves from. Now add debt to that picture. Debt is often sold as a tool, and in many situations, it is. But the Great Depression showed that debt can become deadly when income falls and prices drop. A debt contract usually stays fixed. If you owe a certain amount, you still owe it whether the economy is booming or collapsing. But your wages are not fixed. Your business revenue is not fixed. The price of your crops is not fixed. The value of the asset backing your loan is not fixed. So when prices and incomes fall, debt gets heavier. Not because the number grows, but because your ability to carry it shrinks. That is exactly what crushed so many families and farmers. A loan that looked reasonable in a strong economy became unbearable in a weak one. A mortgage that seemed manageable when customers were spending freely became a trap when sales dried up. Land purchased with confidence became impossible to defend when the income from that land collapsed. People were not only losing money, they were being squeezed between fixed obligations and falling reality. That squeeze is one of the central lessons of the Great Depression. In a severe downturn, flexibility can be worth more than ambition. The families in the strongest position were often not the ones chasing the highest upside. They were the ones with the fewest obligations they could not escape. They had less debt, lower fixed costs, more room to breathe, and fewer promises hanging around their necks when the air got thin. This matters today because modern life is full of fixed obligations. Mortgage payments, car payments, credit card balances, business loans, personal loans, subscription creep, lifestyle inflation, school debt. High monthly commitments do not feel dangerous when income is steady and asset prices are rising. In good times, people call it leverage, growth, expansion, opportunity. In bad times, the same structure reveals its real name, fragility, and fragility is expensive. Another lesson from the Great Depression is that not all assets are equal when systems are breaking. In normal times, people compare returns. In crisis times, people discover the difference between an asset that depends on somebody else's promise and an asset that keeps its value or usefulness without that promise. Think about the difference between a bank deposit, a stock certificate, a government bond, cash in hand, productive land, tools, skills, or precious metals. In good years, these may all seem like pieces of one big financial puzzle. In bad years, their differences become sharp and painful. A stock can collapse because future earnings disappear. A bank deposit can become hard to access if the institution fails or if panic freezes the system. A business can lose customers. Real estate can drop in price and trap the owner under debt. But some assets hold power because they remain useful even when confidence disappears. This is why the Depression taught people to ask a deeper question than, what gives the best return? The deeper question is, what still helps me if the system stops behaving normally? That question changes everything. A savings reserve matters not because it is exciting, but because it buys time. A debt-free home matters not because it makes you rich, but because it reduces the number of ways you can lose. A skill matters not because it looks impressive on paper, but because it can still create value when companies stop hiring. A strong local network matters not because it sounds sentimental, but because in real crises, help often travels through human relationships before it comes through institutions. If this is already changing the way you see money, pause for 2 seconds and do something simple. Subscribe, send this video to one careful person, and save it for a day when headlines feel a little too calm. The people who prepare early usually look silly right up until they look smart. And one of the biggest myths about economic collapse is that it hurts everyone equally. History says otherwise. Severe downturns punish specific weaknesses. During the Great Depression, the pain was especially brutal for the disciplined middle class. Not the very poor, who often had little financial structure left to lose, not always the very wealthy, who usually had more diversification, more influence, and more options. The real devastation often hit people who had done what society told them to do. Work hard, save regularly, buy a home, keep your money in the bank, trust established employers, follow the rules. Those were not foolish choices. In normal times, they were sensible. But the Depression revealed that sensible behavior inside a fragile system does not always produce safety. The system itself can fail the people who trusted it most. That is a painful lesson because it challenges a comforting belief. Many people want to think that if they are responsible enough, the world will reward them with stability. History does not guarantee that. Responsibility helps. Discipline matters. But if all your safety depends on one salary, one bank, one industry, one government promise, one property value, or one chain of assumptions remaining intact, you may be safer than average in good times and more exposed than you realize in bad times. This is why concentration risk matters so much. A person with one job in one sector may feel safe for years. Then a recession hits that sector first. A business owner with one key supplier may feel efficient. Then that supplier fails. A family with most of its wealth tied up in one house may feel secure. Then local property values fall while income drops. A saver with all reserves parked in one institution may feel organized. Then access becomes the problem. Economic collapse often reveals hidden concentration. The Great Depression also exposed the danger of believing that large institutions are automatically safe. Big banks looked solid until they were not. Major employers looked permanent until they cut payrolls or collapsed. Whole industries looked untouchable until demand disappeared. The lesson is not to live in paranoia. The lesson is to understand that size is not the same as invincibility. People often confuse familiarity with safety. They trust what has existed for a long time. They trust what everyone around them trusts. They trust what feels boring. But some boring things are safe and some boring things are just common. The Depression taught people to separate those two ideas. Then there's employment, maybe the most emotionally difficult lesson of all. For many people in the 1920s, a stable job at a respected company felt like the foundation of adult life. That feeling still exists today. People build mortgages, school plans, family budgets, and retirement expectations around one paycheck continuing to arrive. That is understandable, but the Depression showed that a paycheck is not an asset. It is a stream, and streams can dry up. When unemployment surged, millions of people learned that income can vanish faster than expenses, that one reality destroys a huge number of financial illusions. A household that looks healthy with full employment can become extremely vulnerable after only a few months of disruption. That is why cash flow matters more than image. It is why emergency reserves matter more than status purchases. It is why low fixed expenses can quietly outperform high-income lifestyles when the cycle turns. And it is why side skills, second income sources, and useful practical abilities matter more than many people think. A person who can repair things, grow food, teach a skill, do contract work, rent a room, or sell a needed service has more resilience than someone whose entire life depends on one employer's payroll department. During the Great Depression, people who had secondary ways to create value often suffered too, but they had more paths to survival. The same lesson applies now. You do not need to become a survivalist. You do not need to expect the end of the world. But relying on one narrow channel for all income is a gamble many people make without realizing it is a gamble. And there is another layer, one that money advice often ignores because it is hard to measure: community. In major economic stress, people do not survive on spreadsheets alone. They survive through trust, exchange, support, reputation, and relationships. A neighbor extends time. A family member shares housing. A local business gives flexible terms. A church, club, or community group fills a gap. A friend connects someone to work. Informal support systems become real economic infrastructure when formal systems fail. That does not mean community replaces preparation. It means isolation is more expensive than many people understand. So if we pull these lessons together, a pattern appears. The Depression punished dependence on fragile structures. It rewarded room to breathe, room to adapt, and room to wait out chaos without being forced into terrible decisions. Forced decisions are where wealth dies. People sell good assets at bad prices when they must. They borrow on terrible terms when they must. They raid long-term plans when they must. They panic when they have no buffer. That is why so many financial resilience comes down to reducing the number of moments when you have no choice. And now we arrive at the question that matters most for today. If a serious economic collapse came now, what would actually protect your money? Not perfectly. Nothing is perfect. But historically, a few principles stand out. First, low debt is protection. Not glamorous, not exciting, but powerful. The less you owe, the fewer ways the future can corner you. Debt takes a normal problem and adds a clock to it. During stress, clocks become weapons. Second, liquidity is protection. You need access, not just value on paper. Assets that cannot be reached, sold, or used when needed may not rescue you when pressure is immediate. Third, diversification is protection. Not just across stocks or funds, but across institutions, income sources, and forms of value. A person diversified only inside one system may still be overexposed to that system. Fourth, useful assets are protection. Skills, tools, productive property, reliable transportation, practical supplies. These may not impress anyone at a dinner party, but they can matter far more than impressive numbers on a screen when the environment gets rough. Fifth, adaptability is protection. The people who survive deep downturns are rarely the people with the most elegant plan. They are often the people who can change fastest without breaking. Let me make this more personal. Imagine two households. The first looks successful. Big mortgage, 2 car payments, high income, most savings invested, little cash, expensive lifestyle. One job covers most of it. The second looks less impressive. Smaller home, lower fixed costs, more cash reserve, some savings spread across different forms. A side income source, fewer status symbols, strong family ties. In a booming economy, the first household may look smarter, richer, more advanced. In a severe downturn, the second household may sleep better, recover faster, and keep more control. That is the uncomfortable truth. Financial strength and financial appearance are not the same thing. If you have ever felt pressure to build a life that looks successful from the outside, remember this. The Great Depression did not care about appearances, it cared about structure, and structure is usually invisible until stress reveals it. If this is hitting a nerve, here's your second reminder. Don't just watch this alone. Drop a comment with the biggest lesson you're hearing. Subscribe if you want more clear-eyed history like this, and share it with the one person in your life who thinks safe and popular mean the same thing. Now, we should be careful. Studying collapse does not mean predicting doom tomorrow. It means understanding permanent truths that become obvious during extremes. One permanent truth is that rising prices can hide weakness. In the late 1920s, people mistook expanding markets for expanding safety. The same thing happens in every cycle. When assets rise for long enough, people stop asking what could break them. Success creates amnesia. The longer a boom lasts, the harder it becomes for people to imagine conditions reversing. That is why downturns feel shocking even when the warning signs were there. Another permanent truth is that institutions can be both necessary and vulnerable. Modern systems are stronger in some ways than the systems of the 1930s. There is deposit insurance in many countries. Central banks are more active. Governments respond faster. Information moves instantly. But stronger does not mean unbreakable. It means the shape of the risk may change. Sometimes the danger is bank failure. Sometimes it is inflation. Sometimes it is currency weakness. Sometimes it is debt burdens. Sometimes it is frozen credit. Sometimes it is a long, slow erosion rather than a sudden collapse. So the point is not to copy 1930 exactly. The point is to learn how collapse behaves. Collapse pressures debt. It pressures access to cash. It pressures jobs. It pressures confidence. It pressures weak business models. It pressures overvalued assets. It pressures any life built on the idea that tomorrow must resemble yesterday. And that means protection is not mainly about guessing the exact crisis. It is about reducing your dependence on one outcome. That is a deeper and more useful form of preparation. Most people ask, what should I buy? That question is often too narrow. A better question is, what can I remove that makes me fragile? Maybe it is debt. Maybe it is overspending. Maybe it is relying on one employer. Maybe it is having no emergency reserve. Maybe it is storing all confidence in paper wealth that could swing wildly when fear enters the system. Protection sometimes comes more from subtraction than addition. This is one reason the Depression remains such a powerful teacher. It stripped away financial stories people told themselves. It showed that some forms of wealth were really temporary confidence. It showed that some forms of safety were borrowed from conditions that did not last. And it showed that resilience often looks boring until everyone else loses optionality. Optionality is one of the most valuable concepts in any economic storm. It means the ability to choose, to wait, to hold, to pivot, to say no to a terrible offer, to avoid selling at the bottom, to move, to retrain, to cut expenses without losing everything, to keep dignity because you still have room to think. That room is priceless. The people most damaged in deep crises are often not the least intelligent. They are the people with the least room. No cash buffer, no time, no flexibility, no second path, no margin for error. When the wave hits, they are forced to act under pressure, and pressure makes expensive choices look necessary. The Great Depression is full of stories like that. Families lost farms not because they were lazy, but because prices collapsed before debts did. Workers lost homes not because they were irresponsible, but because jobs disappeared faster than bills. Savers lost funds not because saving was stupid, but because the institution holding the savings failed. These people were not cartoon characters. They were ordinary, serious, disciplined people. That is exactly why their stories matter, because if disaster only happened to fools, history would be less useful. But history matters because it shows how even careful people can be destroyed by structures they do not fully see. So how should that change the way we think today? It should make us more humble during good times. It should make us more skeptical of easy optimism. It should make us value resilience over show. It should push us to ask harder questions about our own financial lives. If income fell sharply, what breaks first? If access to capital tightened, what becomes impossible? If an asset dropped hard, would we be forced to sell it? If a job vanished, how long could we function? If institutions became unreliable, what would still work? These are not fearful questions. They are adult questions. And adults do not become safer by refusing to ask them. Maybe the biggest lesson of all is this. Protecting money during economic collapse is not just about protecting money. It is about protecting freedom under pressure, freedom to stay calm, freedom to make decisions slowly, freedom to avoid panic, freedom to protect your family without begging the system for immediate mercy. That freedom comes from structure. It comes from lowering dependency where you can. It comes from building buffers before you feel desperate. It comes from choosing utility over image. It comes from understanding the difference between value and access, between wealth and leverage, between stability and the appearance of stability. And yes, it also comes from accepting something many people do not want to hear. There may never be a perfect shield. Every era has different threats. Every person has different risks. Every country has different institutions. But imperfect protection is not pointless. The seatbelt does not stop every accident. It just improves the odds when the hit comes. Financial resilience works the same way. So if you take anything from the Great Depression, let it be this. Do not measure safety only by how much you own when times are good. Measure it by how many bad outcomes you can survive without losing control of your life. That is a harder standard. But it is the real one, because when economies crack, the winners are not always the people who reached highest. Very often, they are the people who stayed standing. And in the end, that may be the most powerful money lesson history can teach. Wealth is not only what grows, wealth is what remains useful, reachable, and yours when fear moves through the system and everyone suddenly discovers how much of their life was built on borrowed calm. So look at your own position honestly. Look past appearances. Look past market excitement. Look past comforting slogans. Ask where you are strong, where you are exposed, and where one change today could reduce 10 kinds of pain tomorrow. Because collapse does not send invitations. It does not wait for you to feel ready. It arrives while people are still making plans, still trusting headlines, still thinking they have more time. And that is exactly why the lessons of the Great Depression still matter. Not because history is old, but because human overconfidence is always new. If this gave you a clearer lens on risk, keep the conversation going below, subscribe for the next deep dive, and share this with someone building a future they actually want to keep. One video cannot predict the next crisis, but it can help you meet it with open eyes. The people who survived the hardest years were not always the boldest. They were often the ones who understood a simple truth early. When the world becomes unstable, the safest money is attached to the strongest structure, the fewest illusions, and the most freedom to adapt. Remember that, and you will understand the Great Depression better than most people ever do.